Thanks everyone for joining today. I really appreciate it. I'm going to go ahead and share my screen. I'm in a hotel in San Diego, so I'm used to operating off of my two amazing screens. So I'm hovered over this laptop. So if I'm a little clunky with sharing, please forgive me, but we'll get through this together, right? All right, let me get this going here. Amazing. Okay, fantastic. So as Liz mentioned, my name is Amy Sylvis. We can go ahead and get it shared here. All right. Who am I? What am I going to talk to you all about today? I'm going to talk to you about market research. So I give you a little bit of background about myself. Again, my name is Amy Sylvis with Sylvis Capital. I live in Los Angeles with my husband, Joel. I love to travel internationally. If you follow me on LinkedIn at all, you see that we love college football as well and are very often at those games. As mentioned, I invest in the commercial real estate space with our investor partners in emerging markets throughout the United States. We have almost 1,200 units of apartments under management and 208,000 square feet of flex industrial space and almost 170 million of assets under management. So just a little bit of background about who the heck you're listening to today. And I am incredibly passionate about market research and how it can impact those of us who invest in real estate. So I did want to give you a little bit of background. I wanted to talk a little bit about mindset as well. It did take me 10 years to get to the GP side of real estate syndication. So if you are someone who is trying to get into this space, maybe you've got your foot in the door, it's been a little bit of a slower journey than you anticipated. I just want to encourage you that, this path to financial freedom, to lifestyle design, whatever your goal is through being in the real estate space, it sometimes isn't a complete straight line or straight up. Sometimes there are zigs and zags and those things. And I just want to let you know, if I can do this, truly anyone can. This is actually the picture didn't show up. Darn. Okay, well, the picture is supposed to be of me wearing an N95 mask. I was born with cystic fibrosis. If you're not familiar with what that is, it's a genetic illness where I was supposed to only live to be about 10 years old. That was the lifespan in 1981 when I was born. I'm 42. I cover up my grays, but you can definitely see my wrinkles. I had a lot of things going against me, and I don't share this to brag. I don't share this to, bring a tear to your eye, but we all have obstacles in this life, right? None of us gets through this lifetime without some sort of a struggle. And my path definitely hasn't been, all rainbows and unicorns, but I think through all of us sharing our stories and helping us connect with each other on a personal level, we can gain encouragement on our path and on our purpose. So just wanted you to know a little bit about my background. All right, so let's talk more. Why am I so passionate about market research? In real estate, I think a lot of us, if you've been through some of the guru programs or, maybe you've just kind of dabbled in this space, you've considered, hey, I live in a certain place. Should I just invest in my backyard? What should that look like? Well, I want to tell you that this market research game, aside from kind of what we do with our individual properties and our investments, the market itself can act like the water. I'm out here in San Diego, California. This is a perfect graphic of a rising tide lifts all boats. So despite your business plan for your property, whether it's multifamily, whether it's industrial, like I also do, or any other commercial real estate, you have a business plan, you'll execute that, right? That's what you do. But the market can also lift your property and give it appreciation regardless of your activity with the property, if that makes sense. And I'm pretty casual, so we'll leave time for questions at the end, but if I'm saying something that you want more clarification on, feel free to put it in the chat or chime in. I'm happy to make this interactive. So there are two types of appreciation that I want to make sure everyone understands. It's this concept of forced appreciation and natural appreciation. Forced appreciation, as I alluded to, let's say you're in the multifamily value add space. So you are buying a property that's older, you're going to renovate it, bring it maybe up to current standards of a class B, B plus, maybe A minus in a market, raise those rents. And of course, that's going to force the net operating income of your property and force appreciation for the property. Natural appreciation, and we'll talk a little bit more about what impacts natural appreciation, is going to rocket launch regardless of what you do with your property, generally will increase the value because of these certain market forces and circumstances. So there can be this gorgeous compounding effect that you can have that'll supercharge your returns if you understand both of these types of appreciation. And I do have to say, this varies a little bit by market cycle, but very often natural appreciation can have just as much of an impact on your property's valuation as forced appreciation. So let's choose the right markets and figure out how to do that. Does it make sense? All right, so our focus today is going to be on this concept of natural appreciation and how we can make sure we take advantage of that as we're buying investment real estate. And why is this? I mean, I don't mean to beat a dead horse, but yeah, I have seen firsthand, and you may have as well, choosing this right market can really impact your returns. And I love this concept. I took this from Dave Lindahl, and you may have heard it, but this concept of live where you want, invest where it makes sense. I'm in Los Angeles. You couldn't pay me to invest here. Some people do, that's great. But the concept of real estate investing and taking advantage of this market research and really making sure we maximize the returns that we get for our investments means that it's probably a good idea to spend time doing market research and choosing the right market to invest. You may not live in the geography where it makes the most sense, and emerging markets change all the time, right? So, you're probably not moving all of the time to chase these emerging markets, but that's why economies of scale can be so great and helpful. They can really allow you to invest, again, where it makes the most sense. So what does drive this natural appreciation? What should we be focusing on as we're choosing our market? So population growth, job growth, income growth, and state and local laws are just a handful. If you think about what drives demand, again, we'll use multifamily as an example. It's a supply and demand equation, right? And unless you're building, unless you're in construction and you're building new units, we need to focus on the demand side. So if there are more folks moving into an area, if jobs are growing and doing a great job of growing income for people that live in the area, and of course, if state and local laws are business friendly and amenable, then all of these things will really do a superb job of driving this natural appreciation above and beyond the work that we do in our strategies, in our business plans for our properties. Some other things to take a look at too are, of course, the quality of elementary schools. We've seen this correlate very, very closely to submarket natural appreciation. And then, of course, crime or lack thereof. These two typically go hand in hand, but it's important, as I'll show you later, as we go through kind of tactical steps of how to do this research, those can be both pretty important to focus on. All right, so this is a spreadsheet that we put together every month to do market research and to understand what is going on in our markets. And I'm not saying that you have to, but you can really get pretty nerdy and get together quite a bit of data to understand what's going on in a given market. And I share this not to overwhelm you or to, brag about what we do, but I do want to emphasize the fact, and this is a spreadsheet that we had updated probably about 2 years ago. So it's not what we're currently using, but one single data point, if you focus just on population growth, if you focus just on job growth or just state and local laws, they tell a story, but it's an incomplete story. we have found the most success with our properties that have benefited from natural appreciation and predicting these emerging markets in the United States by compiling these data points together and looking at them in a combined way to really see these trends. Now, no market is going to hit every point perfectly, right? That's simply impossible. But you will see very consistent trends and patterns when you take a look at this data consistently. So look at the chat real quick. Okay. Oh, no kidding. 3 kids with atypical. Yeah, no kidding. Okay, wow. All right. So I want to dive a little bit more deeply into what resources we use. And the vast majority of the resources we use for our market research are free. It's really cool. So I want to show you all tangibly what you can do today to either evaluate the current market that you're in, evaluate a market that you may be considering going into. So this will really make it easy for you all. So I'm just going to close this. We're going to look at websites together. And we can walk through this. So let me go and share my screen again. Okay. How many of you all have heard of the Milken report, the Milken Institute report? If you haven't, it is incredibly powerful. And all you have to do is just Google Milken Institute best performing cities. They typically update it once a year, and they do a great job at a great amount of analysis compiling all this information. So let me show you how I use this and what this looks like. And Liz, how are we doing on timing? I'm just chatting away, completely unaware of how much time has gone by. Just let me know if I'm coming close.
It's like 2 hours.
Yeah,
left.
I would say about 20 more minutes or so, and then
Perfect.
QA.
Good. Okay, cool. 2 more hours. I like the way you think. All right. All right, so this report is completely free. Let me zoom in a little bit just in hopes of making it not so much of an eye chart. Okay, hopefully this is a little bit more helpful. All right, so you've got an executive summary, blah, blah, blah. That's all great. Okay, very good. So what I want to understand, this gives their best performing cities, and I'll show you how they rank them. That's nice. The best performing cities are interesting. What I want to understand is the change. I want to see the trends. So the Milken report looks at larger cities and smaller cities. And what I'm trying to understand is who are the movers and shakers? What's changed the most over the past few years? So in this report, the higher or the lower the number, the better. So if we've got, so we want to understand, this is 2023 rank versus 2022, what specifically has changed? So they do this in the, obviously 16 to 3 is a -13, not a positive, but whatever, that's how they arrange it. So we want to look at the highest change number. So let's look, for example, here, Nashville would catch my eye because out of these tier 1 large cities, you can see Nashville was ranked 25 and 22, and now it's ranked 4 and 23. And again, the lower the number, the better in this metric. The absolute numbers are interesting. They're great, but who is changing? Wilmington, North Carolina, 14 points. That's a big jump. So I hope this is making sense in terms of the absolute numbers, but also the change is what I focus on. So small cities, same thing. You're going to see a lot more movement in this area as well. So we can look at the villages in Florida. I mean, huge move. Not surprising, baby boomers are aging. A lot of folks move to Florida. Maybe not necessarily a place you want to invest in, but maybe something to look out for. Burlington, another North Carolina city, 22. I'm not going to try to pronounce the city in Washington. Prescott, Arizona, very, very interesting. Another Florida, Punta Gorda, and Missoula, Montana. So how are they coming up though with these rankings? So we can go through a bit more. And of course, we want to make sure that what we're looking for in our investments and in our cities aligns with how these folks at the Milken Institute are ranking these cities. So they're looking at trends of employment here and wages reflecting general market conditions. They look at high tech. So for them, things like growth of high tech industries and rate of success at attracting investment from this type of sector, that is important. That aligns with what I'm looking for as well. I think a robust tech sector generally is a good indicator of an excellent market to invest in as well. And then, so housing and digital services, another data point. They think that that is necessary to thrive, to have a thriving city. So for me, this criteria is spot on in what I'm looking for in market research. So I'm very trusting and likely to use the Milken report when it comes out annually and plug it into my spreadsheet, not just in absolute rankings, but changes over time. And again, this is just a more in-depth view of the data points that they have for how they assess the best performing city components. What I also want to show you all is, as we scroll down, and I mean, there's so much data here, you could spend a lot of time checking it out, but I do want to show you that there are absolute rankings as well that you can really dive into. And I love that this also shows the biggest gains overall. So previously they were showing the top ranked in absolute terms and how much those had changed. This highlights the largest movers and shakers. So Asheville, North Carolina doesn't surprise me. Vegas doesn't surprise me. Myrtle Beach, a lot of folks love that work from home and being able to be in that nice area. So let's continue to scroll down. And I just want to make sure you all see these. It's a big report. Sorry for the whiplash scrolling here, if I can get my hotel internet to move. But there we are. Okay, so you can dive deep again if you're interested in understanding these exact data points that go into the ranking. You can see where each ranks if you prioritize some of these rankings more than others, like wage growth. If you feel, as I do, that that's incredibly important to a value add multifamily strategy, you can go and hit on that and see, you know, San Jose. Okay, not surprising that they've got pretty robust wage growth. Reno, Nevada, ranked #2 out of these small cities. So I think you're getting the idea. You can really dive in and nerd out on some of this data as you choose. Oh, Liz, thanks for putting that link there. As you choose your market research. All right. So let me see if I can move this over. So another resource that I really love is called Data USA, and the extension is .io. So it's kind of a funny little thing here, but let me show you how I use this web page and how I think you could use it and for it to be useful for you too. Let's do something like I've been doing a lot of investment in Dallas, Texas lately. So let's take a look at Dallas. As you see, you can put a city name here, and it'll give you the choice if you want to choose a county. I do the metropolitan statistical area. That gives a nice overview of not just the city, but the entire MSA, which I think is more reflective of this kind of overall data gathering that we're aiming for when we do market research. So what I'm aiming for here, again, this website, completely free, a lot of great information. I like to go straight to the economy. And in the economy, we can scroll down to industries. So when we're investing, especially in multifamily real estate, in my perspective, we want a broad economic base of people, of jobs where our renters can get paid. And then of course, you know, they're able to pay our rent. So some cities won't have what Dallas has. You know, Dallas has a lot of different sectors that are stable, that'll, you know, I think are very reliable, even hard economic times, like healthcare, educational services, scientific and technical services, manufacturing. These are robust, stable industries that'll provide steady income for our renters. you may see some other cities that are kind of one or two trick ponies, where they've got one or two major industries, and that's it. You think of maybe military towns. You think of maybe like Midland, Odessa, that are heavily, heavily energy dependent. So again, I would encourage you, and I found good success by choosing and really understanding these markets where there are a lot of different sources of industry and jobs for residents, because that just translates to stability and our bottom line there. All right, let's see. Right, best performing cities PDF. All right. Just want to make sure I'm keeping up with the chat. Okay, so let's do one other city, just so you all can compare and contrast. Does anyone want to put in the chat a city where they want to understand or take a look at the industry base?
I
You can
do.
choose one other, or I can do it
mind.
for y'all. Huh?
I can't find my screen. I got so many screens. I was just
That's okay.
replying back. Sorry. So I'm looking at, I do have multifamilies in Newport News, Virginia, but I'm also looking at Norfolk,
Okay.
Virginia, and also Cincinnati, Ohio. So pick one.
Okay. Which one would you like to look at here?
I'm in the process of bidding on both those states. So
Okay.
I don't.
Want to do Cincinnati? I used to live there.
Yeah.
I'll
Okay,
choose for
that
you.
worked.
Let's do Cincinnati. Yeah, Cincinnati's a cool market. Thank you for the suggestion. I appreciate that. Let's take a look. And again, there are so many different data points. You know, we have limited time here, so I'm not able to show you all exactly how we go through you know, each of these juicy bits of information. But let's go to the economy here, and let's scroll down to industries. All right. So anyone want to chime in? What do you all think of what we're seeing here with good old Cincinnati? How does this make you feel in terms of, is it investment grade? Does it look like a good, does it look like a one-trick pony? Does it look like, sorry?
It looks very colorful, you know.
Yes.
Sure.
Yeah. Healthcare is very strong. I think, or not I think, I know healthcare does extremely well, regardless of economic conditions. Manufacturing can be fantastic. There's a lot of onshoring coming from overseas. I think we all saw the vulnerabilities in our supply chain during COVID, and the Midwest is definitely benefiting from manufacturing growth. Professional and scientific and technical services, very, very strong. So yeah, this would definitely get a thumbs up from me. Very, as you mentioned, colorful, not a one-trick pony. I think all other things equal, of course, you know, there's other things we need to look at for Cincinnati, but just in terms of economic base, I think this looks robust.
So this is 2020 data though?
Mm-hmm. It is. Yep.
Okay. Does that matter that it's 3 years old?
Yeah, so the census happens, as you know, every 10 years. And to get, this is kind of the cadence of this data. So yeah, nothing's going to be typically up to date for the year. Population, you can usually get a nice estimate, but these things typically don't change all that quickly or all that dramatically. It's a really good question. So I feel very comfortable. Yeah, Liz, you got a question?
Yeah, I was just curious, this 1 year growth, 0.602%. Can you kind of frame that for us? What would be a good number? What's a range to look at there? What would be considered low? This 0.602% 1 year growth. Could you just frame that for us?
Yeah, forgive me, where are you finding that growth?
Right next, it says 1.1 million value.
This
on the left-hand side. Yeah.
So this you can get more real-time information on. This is economic growth. So yeah, I am more concerned with the data points of what's the current unemployment rate, what's the population growth. I don't see as much of a correlation with economic growth per se, especially exactly to the point that was made earlier. 2020 was COVID. There's not a lot of reliable, a lot of things were in flux there, but we can get real time today, this month, from the Bureau of Labor Statistics, what the unemployment rate is. And Google, believe it or not, with a simple Google search can actually give us, I think they're up to 2022 level population data. So that I would feel would be much more reliable. I would use the right side of the screen and kind of what industries there are instead. Does that help? It's a good question. Thank you for chiming in. Cool.
Just to add on to what Jeff said, let me turn on my video here. Do you supplement your research with, let's say, for example, with AI, given you're looking at, census data, right? So to bring it more current, do you do more additional research by doing a Google search or some other type of searches, or supplement it with an AI, research to get more accurate data? Is that what you do, or how do you do it?
Yeah, so the data points that I mentioned are some of the key data points that I use, readily available. I mean, I don't need an AI I pay a virtual assistant to gather that data and put it through. There are very sophisticated demographic projection models out there. You can pay a good amount of money to have people analyze those statistics and give you that information. Housingalerts.com is one that's incredibly valuable. We decide to pay for it, but it really just kind of confirms what we find with our free resources. So to answer your question, no, I don't use AI for that. The data that we currently are able to access has been incredibly robust and helpful as great predictors for natural appreciation for our projects.
Cool.
Yeah, thanks for asking.
Can you look at Taylor, Texas real quick?
Sure, yeah. Let's check it out. What MSA is Taylor in? Do you know?
No.
Okay, yeah, so this is, why don't you take a look at that, and we can look at it in a bit. I'm guessing it's not its own metropolitan statistical area. This data is the most accurate by MSA. So if you, or we can just look it up together. Tyler, Texas, MSA. Am I spelling the city right?
No, it's TAYLOR.
Okay. Got it. Okay, so let's see. Let's see if we can find the MSA there. If anyone else has found it.
The Austin suburb.
Okay, so it's in Austin. All right, so we can look at Austin.
Okay.
I think we all know what's going on in Austin, but it's worth, let's see if we can find the MSA here. Austin, Texas. I don't know why the MSA isn't popping up. That's interesting. All right, so we'll do this and see what pops up. We'll go to economy. There we go. All right. So very dependent, as we're not surprised, by UT, right? UT is located in Austin. So college town makes sense. A lot of other elementary, secondary education. So that's a pretty large part of the economy. Some tech as well. Engineering makes a lot of sense. Restaurants, yeah, makes sense for a college town. So yeah, I mean, I think we all know Austin is fairly robust. Is it in a bubble? Is it too heavily dependent on, a bunch of annoying Californians like myself that are refugees into Austin? Only time will tell. But does that answer your question?
Yes, it does. But it kind of put it in context for me, specifically in reference to Taylor, Texas, because Samsung is moving there, right? Which is a very huge deal when it comes to Texas. And so
Yeah.
obviously the data
wow.
here doesn't show that. So, but in any case, I get the idea.
Yeah, yeah. It's this is going back to that spreadsheet that I have, right? Where, yeah, we're not going to take just one data point to make a decision. We really need to understand the holistic picture. Being in touch with the Economic Development Committee, and it sounds like you're very much on top of what jobs are moving in and, you know, how that will impact the market. Very, very smart.
Right, right. And I guess that was the core of my question. What sort of supplemental things do you do to enhance your research to get some, you know, real today's data?
Okay. Thank you for clarifying. I think I understand a bit more now. Yes, there is some qualitative data, such as, yes, we talk to economic development committees. We do have Google alerts for new jobs that are migrating. We definitely have boots on the ground and folks that, you know, the Better Business Bureau and things like that in areas where we're interested to understand, yeah, what those latest developments are. Incredibly important. Thanks for clarifying.
So back to your sharing with us in terms of your identifying the emerging markets. Obviously, you go extensive research to identify those markets to make your investments.
Yes, have to. We're in a market called Evansville, Indiana. A lot of people have not heard of that. It's actually the third largest city in Indiana. It's been incredible. And that was a direct result of, yes, all of that market research. And yeah, we invested in it heavily, but it pays just massive dividends. Again, if not more than just our business plan for our properties. Liz, how are we doing on time? Like 5 more minutes, 10 more minutes? What? Sorry to keep putting you on the spot. 10 more minutes. Okay, cool. All right, let's keep going. Let's keep going. All right.
Yeah, and if you need to go a little bit over, if you have a extra 5-10 minutes, feel free. So
Okay.
we're pretty flexible.
Cool.
Great stuff
Appreciate
here, though. Great resources.
Oh,
Thank you.
Yeah, my pleasure. So I talked about Google. Let's check out population growth. This is a very quick way and simple way, but I just want to make sure you all understand. Again, let's do Dallas, Texas together. This is going to be an active exercise. So, all right. So understanding, again, we're not looking at absolute numbers. We're looking at the change. You notice there's a theme here. So I like to look back all the way to the year 2000. So let's say let's call Dallas, 1.288 million. In the latest data is 2021. And in 2000, 1.19 million. So what? We're going to say that's a 10% change. If math just off the top of my head, anyone got a calculator that's able to do that better than I can. That's interesting. But so obviously we want to see a city where population is growing, but is it growing faster or slower than the United States population? That's the key that we've found that's important. So we will Google the United States population, but I know we also talked about Cincinnati, if I can spell it right. Aha. So what's been happening in Cincinnati over the past 21 or so years? 330,000 back in 2000, 308,000. That's a population decline. I'm not saying don't invest in Cincinnati. I'm not saying that, but that's a pretty important data point to understand how your business performs, how your property performs is based on demand, right? Based on folks wanting to rent your units. The Midwest can be incredible. It can be a nice steady eddy market, not as many booms and busts. So definitely not trying to deter anyone from investing in Cincinnati, but I do think it's important to make sure that you understand what those demand drivers are for your real estate. So let's look at the United States population, because I do want to compare Dallas to the United States population and what that growth has been there. So I think we're all familiar with the population has grown from 282 to 331. Whoever has a calculator can tell us if I'm not going to be able to do this real time. But the goal for me would be, in that 21-year period of time, how much has Dallas grown in percentage terms? How much has the United States grown in percentage terms? I want those markets that have grown at a higher rate than the US average. Again, it is not a sole predictor of, hey, this market's a slam dunk, always invest there. There are many other factors, but you are really going to set yourself up, because migration is a trend. It doesn't typically happen in just, in isolation, just 1 or 2 years. Yes, we had the Great Migration during COVID. That's shaken things up a little bit. But again, this is why we're looking at a 20-year period of time to understand a longitudinal trend, not just a, just a few-year fluke in time, if you will. Let's see what's going on the track. Oh, thanks, Robert. So 17.5% growth, that is the US, or that's Dallas? I'm going to assume it's the US, I think. So perhaps Dallas is growing slower than the rest of the United States. 7.6. Perfect. Thank you. Thank you. Thank you. Thank you. So does this mean I won't invest in Dallas? No, but it is a data point. And as I stack up the data points, is Dallas a investor friendly, market? Is Dallas, is income growing there quickly? Are jobs relocating into the market? And we just kind of stack all these up and see this pattern. Do we have a lot of green lights? Do we have, red lights? So hopefully that's helpful in terms of how what we've seen evaluating population growth and how to kind of think through that as well. All right. Another website is city-data.com. So we'll do Cincinnati and we'll do Dallas, Texas. And I'll show you all what we look at here. So again, this data is a little bit older, 1 to 2 years. But I do want to make sure, let me check the chat real quick. Oh, perfect. Thanks, Liz. So what I take a look at here is twofold. The median household income and how much it's changed, again, from the year 2000, so over 21 years. So I like to understand, that's a pretty robust growth. Some cities, you may even see negative growth. So again, you can probably plug this into an Excel spreadsheet as you're gathering your data or having your VA do that. But really understanding, is income growing in this area overall, not just 1 year, not just one off, but is there a general trend of income growing? And does that favor what you're looking for in a market? Does that help your renters pay their rent or pay even increased rent? We also see a strong connection of a predictor for a market being robust and great to invest in if we talk about the median household or condo value and how much that's changed over the past 20, 21 years as well. Does anyone know why that might be an important data point? Does anyone have a guess? I'm going to call on you. No, I'm just kidding.
So you're saying, why is it important that we see in 2020 that it was 87K, like 21, it was 267. To me,
yeah,
that just says that there's appreciation and a positive appreciation in the properties.
Yeah, you're spot on. And to stack on that, areas where incomes are growing, where population is growing, values of single family homes are going to increase. And that's a great indicator for what we're looking for in multifamily as well. So if we understand, what are our sources of renters? Some of them are renters by choice. Some of them are renters by necessity, right? The renters by choice are always, they're going to be there. They've decided for lifestyle reasons. They've decided for, maybe flexibility, whatever, hassle factor. They're just going to rent by choice. But those who are renting by necessity, some people may be priced out of the market to be able to buy a home. Now, again, I'm not saying we're going to go, from a values perspective, it's a great idea to go into a supply constrained market and jack up rents on people because they've got nowhere else to live. That's not my style. I would recommend against anyone else doing that too. We can make money in a way that doesn't, mess with people's lives. But if we are in a situation where the economy is thriving, everyone's being lifted up by strong job growth and population growth, there may be an opportunity to provide in a sweet spot apartments for folks that have the money to rent and pay for our premium units in a value add scenario where they may not want to buy, may not be able to buy. So it's just another data point to kind of understand and take a look at how much have housing prices appreciated. Again, it seems intuitive that they would since 2000. You'd be surprised. Some markets, not so much, not very robust. And again, not a deal breaker, but just something to think about. So let's look at Cincinnati real quick, just for fun. I hope you all don't feel like I'm picking on Cincinnati. Definitely not. Just, two
No,
very
you're
different.
helping me out, but
Okay.
the property that I'm looking at is right by the university, the main university, and not too far
Okay.
from the zoo and hospital. So it's a good catch.
Yeah.
It's just when it deals with construction, and I don't live in that area,
Yeah.
getting to know people, that's that part.
Yeah. Makes a ton of sense. There are a lot of factors, right? There are a lot of factors that go into what might make a good market. So let's take a look at household income growth. So as you all can see, this is a little bit less than the growth that we saw in Dallas. Again, doesn't mean that we shouldn't invest in Cincinnati. It's just another data point to kind of consider what might be an attractive market. So we look at about 30,000 in the year 2000, 43,000 in 2021. It's growth. It definitely is, but maybe not as robust as what I would hope for or would look for in a market, all things equal. Again, all things equal. And housing value too. We've come close to, or just a bit over doubling, but not quite there. So again, indicators of a bit more of a steady eddy, maybe not as robust market. All right. So what do y'all think? I think we've hit a bit of our time here, but I would love to take questions. Obviously, I could talk about this forever.